Hello, and welcome to Own Your Retirement. My name is Elbert Lalonde from Kaizen Financial Inc. If you'd like more information about what you're hearing today during our show, give us a call at 586-752-7008, or as always, visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And then while on my webpage, click on my podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon. Okay, so today we're talking about something that's on the minds of a lot of people right now, and that's what next year in the markets could look like, or what I should say this year in 2026, and what that means if you're either preparing for retirement or already relying on your portfolio or income. Now, after years with positive returns, it's natural to start wondering whether the environment ahead will feel familiar or very different. And if you've been thinking, I'm grateful for the gains, but I'm not sure how much of this I should expect going forward, then this conversation we're having today is designed with you in mind. Now, to help frame the discussion, the data and information we're going to be referencing throughout the show today is from a recent article, U.S. News and World Report, titled, "What Do the Markets Have in Store for Retirees in 2026?" Now, it looks at recent performance, current expectations, and how retirees and near retirees might think about the year ahead without falling into the trap of prediction. And as always, I'm joined by my co-host, Tony Shore, who's here to represent the listener at home and make sure we don't lose anyone once the conversation gets a little too technical. Hey, what's going on, Tony?
Hey, Albert. Great to be here. I love the intro. Yeah, I'm basically here to translate and to interpret when necessary. And I think this is going to be a good one. I've had a great week. I know you've been busy. You
Yes.
guys got a fresh coat of paint and freshened up the office there a little bit. So our listeners who are clients or those who want to set up a consultation with you and your team can see the nice shiny new office there.
Yes.
That's awesome. That's great.
Nice little facelift. It was due 10 years. And so,
Sure.
make it more lively and everything. So
Yeah,
that's the idea.
that's great. Now, for today's show, people out there who are saving for retirement, or even if they've already retired, and maybe they're taking income, the last few years have been very favorable, right? The last
Oh
3 years,
gosh,
I mean,
yes,
the markets have
yes.
been great.
Yes, in fact, for many, it's been a strong stretch by almost any historical standards,
Yep.
especially for investors who've stayed disciplined and focused on the long term. The S&P 500, which many use as, let's say, a broad barometer for the stock market, returned about 16% in 2025. And when you look at the past 3 years together, the annualized return has been roughly about 22%. And those kinds of results are well above the markets that have delivered in the past decades.
Yeah. Yeah, and I think that's exactly right, and I think it leads people to wonder how sustainable this really is.
Yes, yes, for sure. In fact, after a run like that, it's reasonable to ask what comes next, and that's where attention starts to turn towards this year in 2026. Now, I've spent time reviewing forecasts from a variety of financial service firms. They're not exactly gripping reads, but taken together, they do paint a fairly, let's say, consistent picture, and most are calling for more of a positive year in the markets this time around again, but just not as the same pace that we have seen recently in the past few years. So it's not going to just be a nice bull upwards. We're gonna have some volatility, but I do feel that the market will end positive for the year.
Yeah, so what you're saying is more growth, but with tempered expectations.
Correct.
Yeah.
I don't see the huge double digits this year, and along with moderate return expectations, many forecasts also point to increased volatility. You have to remember, well, we got a little taste of that last year when markets dipped, remember, in April following the
Yeah.
announcement of the new import tariff regime. And those pairs can be uncomfortable. But in this case, investors who stayed invested, they also saw the market recover just in a few months and finish 2025 on a very good, strong note.
Yeah, true. But that kind of short-term volatility can really test people's resolve. I mean, I'm sure you knew people. I know people who are like, I got to pull everything out of the market. It's going to
Yes.
tank in April.
Yes.
And then if they just waited a month, Record
Yep.
highs, right? Yeah.
Well, that's why we always understand that investing for your future and retirement, it's not about the short term. It's about the long game. You're investing for long
Yeah.
term, never just trying to make a buck for the short term. And Ken, and it's also a good reminder of how unusual the past few years have been from a historical standpoint. Now, the article that we were referencing from notes that Ameriprise recently pointed out that in 2025's market strength, it pushed the S&P 500 towards one of its best rolling 3-year runs on record. I mean, think about it, 65% in 3 years. That's ridiculous, right? And then Ameriprise also noted that if the market were to deliver a fourth consecutive year of double-digit returns this year, it will be something we haven't seen actually since the late 1990s.com era, Tony.
Wow. Well, and right there is where optimism and caution tend to collide, right? Yeah.
I would agree.
Yeah.
And why
Yeah.
not? You learn from past experience. But that's why forecasts start to differ when it comes to what might actually drive returns going forward. Now, one of the biggest points of debate right now is the role of artificial intelligence, AI. Now, over the past few years, AI related spending has fueled significant gains in the large technology stocks, contributing to an outsized portion of the market's overall return.
But that leadership might not look the same this year, right?
Well, that's what many analysts are suggesting. Now, some believe AI may account for less of the market's return this year, which is why you're seeing more interest in value oriented stocks and non US investments in certain forecasts. Now, with that said, most aren't dismissing AI altogether. The expectation that AI can, let's say, help a wider range of industries improve efficiency and maintain profitability still underpins, well, many outlooks. So it's just that the benefits may be more broadly distributed this time around.
Okay. So let's talk about what all this actually means for retirees.
Yes, yes. So that's the key question, Tony. For many retirees, the approach to investing naturally changes over time. As people age, there's often a shift away from aggressive growth and toward preserving capital. So that can mean dialing back exposure to stocks and increasing allocations to fixed income investments like bonds, along with maintaining cash reserves for emergencies and planned withdrawals.
And that's where that familiar balanced portfolio idea comes in, right?
Precisely. You have that classic 60-40 split between stocks and bonds. It's still a common benchmark for many investors. And it's one that a lot of retirees reference as they think about risk and income. Now, that said, how much income you need and the size of your overall asset base matter a great deal. There is no one size fits all approach here.
Well, and even with that shift towards safety, stocks don't disappear entirely, right? You still
Oh
have to have
gosh,
that growth.
right. They really shouldn't. In fact, history shows that equities tend to outpace other asset classes over long periods of time, which is important, even in retirement, because people are often planning for decades, not just a few years. And so
Right.
maintaining some exposure to stocks can help portfolios keep up with inflation and also support the long-term purchasing power.
Yeah, and on the other side of the equation, they did quite poorly for so long, but bonds may be having a moment, right?
Yes, they're finally bouncing pretty good.
Yeah.
Last year was a good indication of that. In fact, the article explains that Vanguard, one of the largest mutual fund providers, has expressed optimism about bonds in the years ahead. Now, the firm has said it maintains a long term view that high quality bonds, both taxable and tax exempt, they offer attractive real returns in the current environment, particularly given higher neutral interest rates.
And that's not something we've heard a lot about over the past decade, is it?
No, no, it isn't. In fact, for a while, it was just down and nothing. In fact, if you look at
Yeah.
22, where the bonds took a loss with the equities.
Right.
And that's why what makes this noteworthy. Vanguard forecasts that high quality US bonds could return about 4% annually over the next 10 years, which they believe would provide a comfortable margin above expected inflation. And for retirees who rely on predictable income and stability, well, that kind of outlook may play an important role in portfolio construction.
So it's less about just abandoning growth altogether and more about having a balance.
Nicely put, Tony. Yes, it's about combining growth, income, and stability in a way that supports retirement goals without taking on more risk than what is necessary.
Yeah. Well, and another theme that always seems to come up in market conversations is the Fed or Federal Reserve. And we've heard so much lately about interest rates and the
Yes,
Fed, right? What
it
about that?
does. It does. And for good reason. Well, investors have long paid close attention to what the Federal Reserve is doing because interest rate policy can have a meaningful impact on both the economy and the stock market. Now, when interest rates are rising, often in an effort to combat inflation, stocks can face the headwinds. Borrowing becomes more expensive and economic growth can slow. But on the other hand, when rates are being cut as they are now, it tends to create an environment where stocks have historically performed better.
So the lower rates can act like a tailwind then, pushing it
Correct.
along. Yeah.
Yes. And that's why market watchers subscribe to the old saying, don't fight the Feds. Now, with that said, there's a bit more uncertainty surrounding the Feds right now, obviously. Jerome Powell's term as chair is set to end in May. And then recent votes on monetary policy has shown some disagreement among policymakers about the future path of interest rates.
So, unlike the past, it seems now not everyone at the Fed is seeing things the same way, right?
You got it. And it's
Yeah.
still, despite the internal debate, market expectations remain fairly consistent. So many investors are actually currently anticipating 2 additional rate cuts this year, which at least historically would be viewed as supportive for equities.
Yeah. Yeah. And I know I've heard some strategists out there talk about how last year set the stage for what comes next, right?
Yep. Yep, they do. And the article also notes that Jurian Timmer, director of global macro at Fidelity Investments, has suggested that the market's performance in 2025 actually helped lay the groundwork for a potentially positive 2026. Now, he describes 2025 as an unusual year marked by competing forces with things like tariff-related headwinds on one hand and then supportive Fed policy on the other.
Yeah, and I get that's why a lot of folks are in the industry are kind of hedging their bets. Everybody wants to say, "Hey, we think this is going to be a positive year because of those tailwinds you were talking about," but also there's a lot pulling in different directions all at once, and
Yes.
that's why some are hedging their bets a little bit and saying it might be a little lower this year.
Yeah. Yeah. Despite those cross currents, though, several factors actually have helped support the market. One is what's been described as a capital expenditure, or what we call CAPEX, a boom where companies are making significant investments in, let's say, equipment, technology, and infrastructure to support future growth. And then another is the bond market. When risks are rising, bond markets often become more volatile or signal stress. So far, they've remained relatively calm.
Yeah, which says something about the broader picture and the overall economy,
It
right?
does. In fact, taken together, these factors have contributed to a market that has actually shown a surprising level of resilience. And that resilience is a big reason why many forecasts remain cautiously optimistic heading into this year.
Yeah. Yeah. And before we keep going with this conversation, it's a good one. But Albert, I wonder if you could give our listeners out there and viewers some information about how they can get a hold of you. I'm sure they have questions. I know you love hearing from people if they want a second opinion on where they're at, or maybe they don't have a financial plan or a
Right.
retirement income plan in place. I know you're offering a no charge, no obligation consultation, you and the team there at Kaizen, right?
Yes. In fact, folks, if you want to learn where you're at and where your numbers are and how it fits with what 2026 could do, just give us a call at 586-752-7008. Or as always, visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. Remember, when you're scheduling your consultation with us, we will make sure that you understand everything and will work around your schedule.
All right. Sounds good. Yeah, and let's jump back into it. I want to ask you about maybe the elephant in the room. I don't know, and that's AI.
Yeah.
There's a lot of debate about how much AI is going to contribute to market returns in the near term and
Mhm.
throughout this year. Many firms remain constructive on their longer term impact. How do you view that?
Well, yes, while there is debate and about how much AI will contribute,
Yep.
we do have to look at things in a longer impact, as they say.
Yeah.
So iShares, the exchange traded fund arm of BlackRock, continues to view artificial intelligence as a major driver of growth, while also seeing opportunities for other sectors to perform well this year. Now, what's hard to ignore, though, is the scale of investments. More than $500 billion was spent on data centers in 2025 alone. And estimates suggest a total AI related infrastructure spending could reach actually between 5 trillion and 8 trillion by 2030.
Yeah. Yeah. So I know that there is a debate on how much AI is going to contribute to markets, and some forecasters are dialing back, but not everybody is backing away from it. And boy, if those numbers are correct, if it reaches 5 to 8 trillion by 2030, those are big numbers, and that's a lot of growth.
Yeah, they are. In fact, and they matter. The level of capital investment supports not just corporate profit expectations, but remember the broader economic growth as well. And even if AI leadership becomes more, let's say, dispersed across sectors, the underlying investment remains a meaningful force.
Okay. Good to get your take on that. And then that brings us to a practical question for our listeners out there. What should they be doing right now, Albert?
This is where a regular portfolio checkup comes in. The start of a new year is often a good time to step back and review your retirement investments to make sure that are they still aligned with your goals. And then after 3 years of strong market performances, many portfolios may no longer resemble what they look like in 2022. So rebalancing may be necessary just to maintain the same target allocation you originally intended.
And that's before you factor in changes in personal circumstances, right?
You got it. In fact, needs evolve over time, as we know, especially in retirement. And as people age, they may begin drawing down more of their capital, which can change how risk should be managed. Now, remember, it's important to reassess your tolerance for risk and potential loss. And that assessment should be grounded in your income needs and overall asset levels.
But that doesn't necessarily mean stepping away from stocks entirely, right?
Right. It doesn't. In fact, even in retirement, maintaining some exposures to equities can be very important. Historically, stocks have provided higher long-term returns than many other asset classes, which helps portfolios keep pace with inflation over time. I like to think of it this way. The goal isn't to chase the money you want, it's to invest thoughtfully so you have the money you need.
Yeah, there you go. And you've covered a lot today, Albert, including markets, volatility, interest rates, AI,
Mhm.
stocks, and bonds. But for somebody listening, it might feel like, okay, I get this big picture. What do I actually do with all of this?
That's a very real reaction. And honestly, it's one of the main reasons people choose to work with a financial service professional in the first place. Not because they don't understand any of this, but because it's hard to translate market commentary into strategy that actually fits your own life.
Right. I mean, headlines are one thing, but personal decisions are a whole other thing.
I couldn't agree more. In fact, market forecasts, Fed policy, AI investments trends, man, they're all useful contacts, but none of them tell you how much risk you should be taking, how much income you can safely withdraw, or how your portfolio should be structured given your goals and time horizon. A financial service professional is the person that's going to help connect all those dots for you.
Right. And so instead of reacting to each new forecast, you're stepping back and looking at the whole picture.
That's the goal. One of the biggest mistakes investors make, especially after a strong run like we've had, is assuming that recent performance should drive future decisions. A financial service professional can help keep the focus on where it belongs. It's on strategies, not headlines.
And I think that's especially important for retirees or people who are getting close to retirement.
Yeah, it is. In fact, let's put it this way: when you're accumulating assets, volatility feels different. When you're drawing income, the stakes change. Market swings, interest rate shifts, and asset allocation decisions all have a more direct impact on your lifestyle. So, working with the financial service professional helps frames today's market environment in terms of income sustainability, not just what the returns are.
Okay. So instead of asking, what will the markets do this coming year or next year, the question then becomes,
Well, I'm positioned to, let's say, meet my needs regardless of what the market does. Now, that's a much healthier and more productive question. Am I positioned to meet my needs regardless of what the market does? Now, a financial service professional can help model different scenarios, put a written plan together for you. And what happens if returns are lower? What happens if volatility increases? What if inflation stays elevated longer than expected? Those exercises turn uncertainty into actually something manageable. And this is why I encourage everyone, get a written financial plan put together. That way you can actually see your numbers and what the results actually would look like.
yeah, and this is something that people really can't do on their own, especially easily and catch all the possible
Yep.
expensive mistakes
You
they could
know,
make.
when you want to look at it realistically, there's a lot of people who put these, let's say, Excel sheets and all that, and that's fine, but they don't count for everything from taxes to inflation, all of that. They just go by debit and credit, you know? And so this is where your financial service professional is really going to make a difference here for you. Most
Yeah.
people don't have the tools or the time and actually to stress test their strategy across multiple scenarios. And even if they did, think about it. It's hard to be objective about your own money. And that's another key benefit of why having someone who isn't emotionally attached to your portfolio is going to be good for your team.
Yeah. I mean, emotions have a way of showing up at the worst possible times, right?
They
Especially
do.
when it comes to your own money. Yeah.
Yes. And volatility, like we talked about earlier, can prompt impulsive decisions. A financial service professional acts as a stabilizing force, someone who helps you stay disciplined when markets get noisy. And discipline matters far more, I would say, to long-term outcomes than perfectly timed decisions.
Yeah. And you mentioned rebalancing earlier. That's another area where guidance really helps, isn't it?
Yeah, I believe that wholeheartedly. In fact, after several years of strong equity returns, many portfolios actually drifted away from their original targets without investors realizing it. You know, rebalancing isn't about predicting the market. It's about maintaining the level of risk you intentionally chose. And a financial service professional helps ensure that your portfolio still reflects your goals, your income needs, and your tolerance for loss, not just performance.
Right. Right. There you go. And that tolerance can change over time, actually.
Actually, it often does. Life changes, health changes, income needs change. A strong financial strategy, like I said before, isn't static. It evolves. And then working with the financial service professional creates a process for revisiting and adjusting the strategy as circumstances shift continuously.
Yeah. Yeah. There you go. And I think that this is so, so important. And it's not just about investments, is it?
No, not at all. In fact, investments are only one piece of the puzzle. A comprehensive strategy also considers taxes, withdrawal sequences, and cash reserves and legacy goals. For example, how and when you take can be just as important as how your portfolio performs. A financial service professional helps coordinate those decisions so they work together rather than at cross purposes.
Right. And that coordination seems especially valuable in a year like this where there's optimism, but also uncertainty.
Mhm. When forecasts are mixed, think moderate growth, higher volatility, shifting leadership in the market. Man, it's easy to feel pulled in all these multiple directions. But a financial service professional is who's going to help cut through that noise, answer a simple but powerful question. Is your plan still on track?
Yeah, that's the question. But what if it's not?
Well, then you adjust thoughtfully, deliberately, and without context, not because of fear and not because of hype. And that's the difference between investing as a strategy or investing as a reaction.
I love that. And that actually brings us back to something you said earlier, right?
Yeah, right. The idea that investing should be about having the money you need, not gambling on the money you want. A financial service professional helps keep that perspective front and center. They help align your portfolio with your actual real world goals, your income, your stability, and flexibility. So market outcomes don't dictate your peace of mind.
Well, yeah, and that's if somebody's been listening today and they're out there thinking, "Hey, I understand more than I did an hour ago, but I still don't quite feel confident." That's normal, right?
Yeah, correct. In
Yeah.
fact, it's also a good signal. Confidence in planning for retirement doesn't come from having all the answers. It comes from having a process and a partner. Working with the financial service professional helps turn information into understanding and understanding into action. And over time, that's what builds a stronger, more resilient financial strategy.
And that's what we've been talking about. That's what our conversation has been about today, right?
And you know what? What an excellent summary. It's not predicting the future, it's about preparing for it.
All right. Excellent show today. A lot of great information, Albert. Kind of a 2026 outlook for the rest of this year for those close or in retirement. So, how can our listeners get a hold of you? What do you want to leave our listeners and viewers with today?
Folks, if you have questions about your retirement, your financial strategy, if you want to get a financial plan down on paper so you can actually know your numbers and not react with the news headlines, please visit my website, www.kaizenfinancialinc.com, or call my office at 586-752-7008. We love to help you protect your savings and help you feel more confident about the road ahead so you can own your retirement.
All right. That is great, Albert. And listeners and viewers, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.